Wealth Secrets. Welcome to a new short course titled Wealth Secrets, taken from the book Training Courses by Muteb Alqarni. In this course, we will delve into the secrets and principles embraced by the affluent in their pursuit of wealth building, with a focus on empowering individuals with average incomes to enhance their financial prospects. Our discussion is not directed towards millionaires or the impoverished. Millionaires do not need to be taught the secrets of wealth as they are already familiar with them, and the impoverished are preoccupied with making ends meet. We will divide this course into 3 sections: pre-investment tips, investment tips, and post-investment tips. Let's begin with the first section. In the first section of the course, we will discuss pre-investment tips. The most important and foremost tip in this section is to define your financial goals. In other words, determine the amount of wealth you want to build after 1 year, short-term goal, after 5 years, medium-term goal, and after 10 years, long-term goal. Ask yourself, how much money do you want to have 1 year from now? 50,000? And how much after 5 years? 250,000? And what about after 10 years? 1 million with investments. Having such primary goals will push you towards organizing your life, reviewing your accounts, managing your expenses, and reducing your liabilities. Having a specific goal will motivate you to take all the preceding steps. With goals set, the second step is to curb unnecessary expenses. Increasing your wealth starts when you restrict your money thieves. Anyone who knows the thief will protect the money. The first thief of your wealth is trivial luxuries. Restrict this thief by only purchasing needs, not wants. The second thief is excessive dining out, so cook and have coffee at home. The third thief is excessive gift giving, so cut down on gifts. The fourth thief is branded clothing, so buy acceptable clothes. The fifth thief is excessive taxi usage, so walk or buy a bicycle. The sixth thief is buying books, so borrow or download books. Anything with an alternative is a thief, and you must stop it as quickly as possible. After getting rid of unnecessary expenses, restrict periodic liabilities, meaning everything you are obligated to pay to others regularly. Reduce debts as they entail paying interest, which in turn diminishes your wealth. Get rid of credit cards, as they involve paying off loans and increase your consumption. Reduce bills altogether, as they are obligations you have to pay regularly. Be wise in using electricity and water when not needed, and decrease mobile and internet packages if your usage is low. Cancel subscriptions to gyms that you rarely visit and subscriptions to Netflix and Amazon Prime if you don't need them. Subscriptions are liabilities that consume your money. After eliminating unnecessary expenses and restricting periodic liabilities, make others contribute to some of your expenses. For example, activate your use of coupons and discounts, and target seasonal offers from major stores like Walmart, Publix, and Lowe's. Buy in bulk what you need and what has a long shelf life to reduce its cost. Also, activate the use of bank cards with points and cashback rewards. Buy cheap alternatives from online stores rather than physical stores, and always compare prices between stores. In short, save as much as possible by making others bear part of your expenses, either through coupons, offers, points, etc. After getting rid of unnecessary expenses and restricting periodic liabilities and making others contribute to some of your expenses, you will find that your money grows and multiplies just by restricting the money thieves. Here comes the step of doubling your money by doubling your income streams. By engaging in additional work that generates income other than your job. Work after your regular job as a consultant, writer, translator, graphic designer, or any other service provider. Try working as a delivery driver, or rent out your car through secure applications, or act as a marketer for companies, or open an online store, or provide useful content on YouTube and TikTok to earn from advertisements. Diversify your work to multiply your money. After doubling your income and increasing your wealth, the importance of saving comes here as a crucial step in wealth building. Save from your available income sources as much as possible following the 50-30-20 rule, where you allocate 50% of your income for basic expenses, 30% for non-essential desires, and 20% as a personal commitment to your savings account. Saving is important for two reasons. Firstly, it builds a personal emergency bank sufficient for 6 months in case you lose your job. And secondly, it gives you the opportunity to invest from your savings account comfortably. Success comes to those who invest from their personal savings, not through high-interest loans. After building a personal emergency bank through a savings account, optimize your expenses. Optimize your expenses by adopting the rule of less is more and the rule of quality over quantity, focusing on buying fewer items of higher quality and better value. Instead of buying 3 low-quality mobile phones that last for 1 year and clutter your home, buy 1 high-quality mobile phone that lasts for 5 years. Instead of buying a used car with frequent breakdowns, buy 1 new high-quality car that lasts without breakdowns for 10 years. Focus during all this on less, quality, and value, the trio that improves your life. After improving your life by purchasing the best products, secure your purchases through any means of insurance to protect your savings and assets from damage and faults. Insure your mobile phone in case of screen or camera breakage or internal parts damage. Insure your new car for 5 years with full coverage. Remember that the mobile phone you carry and the car you drive are your cash assets, just suddenly turned into tangible assets. In short, protect your wealth from damage and protect your savings from unexpected expenses. Good insurance ensures your benefit from these products for longer periods and guarantees you new alternatives in case of complete damage, especially with full coverage. After improving your life and securing your assets, invest in yourself. Yes, self-investment is the best investment, and it is a necessary stage before the stage of investing saved money. Reduce your possessions and purchases by limiting them to fewer numbers, higher quality, and higher value, and double your investment in yourself by attending courses and learning skills. Invest in building important skills that help you in the financial investment stage in particular. Invest in courses on decision-making to make successful investment decisions, courses on problem-solving to solve investment problems, and courses on negotiation skills to master negotiation with others for winning deals. Build yourself by improving your skills. Last piece of advice in the pre-investment tips section. Build your relationships, meaning establish fruitful and effective relationships with traders and the wealthy. As those you accompany, you become like them. Choose beneficial and effective relationships, for the rule says, your network is your net worth, and a person is not what he knows, but who he knows. Yes, strengthen your relationships with experienced and seasoned investors, bearing in mind that investing your money through personal effort may not yield benefits and could even be more harmful. Consult with an expert or join an investment group, seeking advice on the right investment avenues in exchange for a share of the benefits and profits. Don't trust yourself too much, as the voice of experience prevails over the voice of knowledge. We now move on to the investment tips section. The first advice in this section is, do not invest in get-rich-quick schemes. In short, beware of investment programs promising exorbitant and quick returns, such as stock trading and unlicensed investment companies, which lack oversight and accountability. Therefore, building good relationships becomes a secure advice, as trustworthy advisors do not believe in the possibility of quick wealth. Building wealth from their perspective requires patience and discipline, with goals extending from a year to 5 or 10 years. Monitor your goals patiently and make your foundation not based on quick and excessive wealth. This way, you improve your investments and avoid scams. The second advice: invest in the right assets and invest early. Yes, invest early and don't wait too long, as history confirms that inflation, the rise in prices of goods and services, is on an upward trajectory, meaning that your savings and money will have a lower value 10 years from now. So, what you can buy now for $3, you'll buy for $5 after 15 years, meaning the value of your non-invested savings will decrease. Early and urgent investment is the safe and guaranteed solution, as it contributes to increasing compound interests and reduces the risk of unpredictable taxes, thus maintaining the purchasing power of your money. None. The third advice: invest in the stock market. Historically, the stock market provides higher benefits and returns compared to other investment opportunities. Try investing $2 million in the stock market and distribute them among 10 major companies. And after 10 years, the profits could reach $3.5 million, surpassing inflation. Additionally, major companies offer annual dividends to stockholders, which could amount to $100,000 annually for an investor with $2 million, for example. $100,000 annually as profits for the coming 10 years without interruption? It's a successful investment, as it's equivalent to your salary for a whole year, and it provides job security as companies pay your salary while preserving your capital. The fourth advice: invest in real estate. Whether in the form of lands or buildings, properties, real estate is a winning option preferred by many investors because real estate holds the attribute of tangibility, meaning it's visible compared to invisible stocks. Stocks may vanish and not be seen during market crashes. Yes, invest in real estate as well, by buying land or a property. They say, El-Aikar huwa ibnul bar. Real estate is the virtuous son. And as Franklin Roosevelt says, real estate cannot be moved, so it will not be lost or stolen. Real estate is an expansive investment source, with investment opportunities being either commercial or rental, meaning properties can be leased to companies, ensuring steady income sources unaffected by stock market fluctuations. The fifth advice, after considering stock and real estate options, is diversify your investments, which is the advice that never fails in the investment field. The rule says, don't put all your eggs in one basket, so if the basket falls, all the eggs break. Therefore, diversify your investments. Don't put all your money in one company, but distribute it among major companies in the stock market. Then, buy real estate and diversify between lands and properties. Try investing some of your money in the global stock market and some in investment funds, some in digital currencies, and some in gold and silver, and some in a small business project. Diversify your investments, and you won't lose through diversification. provided you hear the opinions of specialized advisors. The sixth advice is, calculate the risks. Every successful investment is built on a good risk calculation. The decision to invest in the stock market should be made after calculating the risks of the stock market, as some lost all their money in the stock market crash of the Great Depression, 1929-1939. So, don't risk all your money in stocks. Similarly, the decision to invest in real estate should be made after calculating the risks of real estate, as it may be exposed to earthquakes that demolish buildings, as happened recently in Turkey. So secure your properties as a precaution. Calculate the risks and venture into digital currencies, as those who bought $1 of it in 2010 made a profit of $20,000 in 2017, with no risk of losing a dollar if it happens. The seventh advice after calculating the risks is, seize opportunities. Opportunities do not come back, so don't expect an opportunity to earn $20,000 from $1, for example. But seize new opportunities if the risks are low, as opportunities come with trends. Seize new opportunities when conditions are bleak, as opportunities come as gifts during crises. British banker Baron Rothschild says, "The time to buy is when there is blood in the streets, even if the blood is yours," indicating that disasters are investment opportunities for those who want to buy valuable assets at discounted prices. And the COVID-19 pandemic is no exception, as it created investment opportunities by causing a decline in the stock market and a decrease in real estate demand. During disasters and emergence of opportunities, negotiate for the best deals, and always remember the eighth advice, which is, negotiate justly. All prices decline with the emergence of disasters, and all investors are in a state of fear and panic, wanting to sell and protect themselves from harm. Therefore, do not hesitate during opportunities to negotiate more, but fairly, not excessively or exploitatively, as the exploiter does not always win. Yes, negotiate justly, and be cooperative with the seller, not exploitative. If you offer the minimum and the seller offers the maximum, accept a middle ground that satisfies both parties. Negotiate and don't show too much enthusiasm for the opportunity, and don't make the seller feel your fear of losing the deal, following Trump's wisdom. The worst thing you can do during negotiation is to show your desperation for the deal. During disasters, emergence of opportunities, and the start of negotiations, invoke the ninth advice, which is, don't follow the herd. The herd are small investors, while those who don't follow the herd are the big wealthy ones. Always be with the wealthy minority, following Warren Buffett's saying, "Be fearful when others are greedy, and greedy when others are fearful." The rush of people to invest in one place means their greed. So be cautious then, as happened with the Yansab stocks, as they were declared low contrary to the public herd's expectations. And when people hesitate to invest, this confirms their fear and panic. So be greedy then, as happened with Aramco stocks, as they were declared high contrary to the public herd's fears. The majority of herd mistakes come from their susceptibility to prices. Therefore, the 10th and final advice is, invest in value, not in price. In other words, focus on value as it is enduring, and do not be swayed by the fluctuating prices of companies and real estate. Choose assets with high value, which increase over the years. For example, invest in oil companies even if oil prices are fluctuating, as the value of oil remains stable for the next 20 years. Invest in telecommunications companies even if their prices are fluctuating, as the value of communication and the internet remains constant and always increasing. Also, Invest in cement companies because cement will remain valuable, as urban construction never stops. After finishing the investment tips section, we now move on to the post-investment tips section, with the first tip being stay informed. Stay informed about economic news and changes in stock prices, real estate, and other investments. As the fundamental rule says, knowledge is power. Staying informed means knowing about new companies and favorable opportunities to invest in. It also means being aware of risks. So pay attention to two things. 1. Stay away from risky new companies you might invest in. And 2. Be alert to the decline of your old companies you've invested in to withdraw your money from them. Despite the importance of staying informed about global news, the following advice in post-investment is: beware your emotion. Beware of misleading and alarming news that may push you into panic selling. Not all collapses in the stock and real estate markets require a quick exit from the market, so don't listen to your emotions. In short, don't exit the market with any news of a new collapse, remembering that such collapses and fluctuations will diminish over the long period you've set for investing, which is 10 years. Control your emotions, following Warren Buffett's saying, "The best quality in an investor is temperament, not intellect." After cautioning against fleeting emotions, beware past experiences. Expectations during the COVID-19 pandemic warned of crisis deterioration, and investors hesitated to buy despite the presence of COVID-19 as a disaster and a passing opportunity. The COVID-19 pandemic was frightening due to scientists' inability to predict its disappearance from the world. Consequently, it's expected that investors in the future will assume any new virus is like the COVID-19 virus. Therefore, beware of investing based on past COVID experiences, as the new virus may disappear after 15 years, trapping you in the deception of past experiences. Seek advice and review. As they say, learn from the past, but don't let it dictate your future. In the event of a new virus outbreak, take the fourth advice: withdraw and return. In other words, if you feel market turmoil due to the emergence of a new virus like COVID-19, withdraw quickly, but with the intention to return. Sell stocks at high prices with the intention of buying them back at low prices. In other words, follow the rule: sell high and buy low. Sell your company's shares at $50 with the intention of buying them back after the turmoil period at $40. It's a winning deal where you rotate your money within the same company, saving yourself from the disaster sequence, as profits compensate for losses. In the event market turmoil turns into a market crash due to a sudden war, the fifth advice will be: withdraw and change. When the stock market collapses in a country due to a sudden war, the best plan is to withdraw from the markets of that unstable country with the intention of changing your investment direction to a more stable new country. Yes, wars may harm global markets, but their effects on a war-torn country are greater than their effects elsewhere. Don't keep your investments in a tumultuous country. Instead, move to new regions and countries, and the profits you'll gain in the new country will cover the sudden losses you incurred in the troubled country. Change and diversify. This is the guaranteed solution. When directing your investments to new countries and noticing that collapses are severe on an international level and have not improved, here comes the sixth advice: withdraw only. In other words, do not withdraw with the intention of returning or changing. just withdraw. This advice is appropriate in the event of global market collapses altogether, as happened during the Great Depression period, 1929–1939, and its aftermath of the Second World War, which affected stock and real estate prices globally. Sell all your assets and keep the money in cash, following the motto, "Cash is king." Cash can be converted into property or stocks at any later time. After the global crisis ends, the eighth advice is, come back to investing, remembering that money is for investment, not for saving. Invest again and maintain your composure towards the losses you incurred during the previous crisis. Do not mourn the lost money, but reconcile yourself to investing while accepting losses. As the rule says, no investment without risks. Make your motto Churchill's saying, "Success is not final, failure is not fatal, but the courage to continue is what counts." Continue your investment journey, considering the lessons learned from your previous losses. Keep learning, as the more you learn, the more you earn. After loss, before investing, during investing, and after investing, don't forget the last advice. Give back to your community, family, relatives, and people in general. Donate and give zakat continually, remembering that everyone is a partner in the success of your investment. Everyone you see in your community has contributed to building your wealth, whether directly or indirectly. Make your goal of investing to take money from the rich to give it to the poor. Make the purpose of your investment capabilities to help the needy and stand by them against the greedy. Make the goal to donate to charities that align with your causes, such as supporting children's rights organizations, if children's rights are your primary concern. Finally, we reach the conclusion of the Wealth Secrets course. In this course, we learned a lot. And the best thing we learned is that investment occurs in stages: pre-investment stage, investment stage, and post-investment stage. We provided specific tips for each stage. We said that the best investment is to guide your budget, review your expenses, and improve your expenditures. Then, increase your income sources and savings, invest in yourself, and build your relationships. After that, enter the markets and invest early. Diversify constantly, calculate risks, then seize opportunities, choosing value over prices, and staying informed about news as a post-investment stage, either to withdraw and return, withdraw and change, or withdraw only. And finally, keep learning and don't forget charity. This training course, Wealth Secrets, is taken from the book Training Courses by Muteb Alqarni.